Welcome back. Indian stock indexes have been having a tough time. It was not just a bad 2025. In 2026, February 2nd, 3rd, we seem to find our feet with the announcement of the US-India trade deal. But to look at the performance month to date itself, Indian Sensex and Nifty down about 2%, whereas most other indexes, Kospi up 32%, the Brazilian index, Bovespa, is up almost 14%. In fact, MSCI emerging markets, let's take that index, that's up 7%. So clearly the IT negative wave is having a very bad impact on the Indian stock indexes. Where do we go from here? Is the mood changing? Are we close to bargain buy levels? Joining me now is our market master, Manish Gunwani, head of equities at Bandhan AMC. Manish, good morning. Thank you very much. Difficult morning, difficult times. What is your understanding at your end of the IT stocks? Bargain buys or falling knives?
Well, Latha, I wouldn't be too contrarian here and say they are bargain buys. Obviously, valuations have corrected a lot. But we have to acknowledge that the impact of AI on coding effort is enormous, right? So I do think that when you see global stocks like Accenture, Capgemini, EPAM, they seem to be a bit more cheaper than Indian IT services companies. Second is that when you see the currency, at least till now, I think they've been getting the benefit of rupee depreciation. My personal view is that there's not much left for rupee to suffer. So that benefit also for this sector is kind of dissipating. So overall, um, you need to be very brave to own this sector at this point of time. I don't think I think it's a bit too early to jump in.
Okay. There were some very convincing arguments made by Nandan Nilekani at the Infosys AI Day and by Chandra in the AI Summit itself. He spoke to CNBC-TV18 as well. They are clearly seeing a business case as integrators of legacy systems so that they make companies, enterprises AI ready. You don't see that as a decent business case?
No, I do. So what has typically happened with this industry is whether it was Y2K or cloud, that logic has worked. But you have to remember two or three things here. One is that AI impacts coding in a massive way quite directly. So when you see the negative impact versus what can come positive, it's a bit more trickier than cloud or Y2K or whatever, right? The second is the base of revenues is very, very high, right? We're talking of a lot of the large caps having employee workforces of 2 lakh, 3 lakh, 5 lakh, whatever.
Yeah.
Now, to retrain those kind of workforces is going to be a much, much bigger challenge than, let's say, 10, 15 years back, right?
Yeah.
Third is, as I said, a lot of foreign investors have cheaper choices available globally. So in that context, I do feel that, as I said, a bit too early to jump in.
Okay, fair enough. I'll come to the AI theme again. It's not going away. But at the moment, do you think Indian markets are at bargain buys? I mean, we are piercing through even technical supports. Are you fishing for buys in other areas? Which?
I think India's underperformance to EM or global markets is mostly done. But we've not seen the classical indicators of a global risk off, right? When you see credit spreads globally, when you see volatility globally, from a contrarian indicator perspective, these are very, very benign levels at this point of time. So I do think, as I said, that maybe our underperformance to global markets or to emerging markets is coming to an end. But if there is a global risk off, which may happen either because private credit blows up or oil goes to 90 or whatever, I think that pain, if it happens, is still left.
No, I think on the global markets, we are ignoring the fairly solid growth numbers that are coming from the US. So I'm not one of those who's crying wolf about a chaos around the corner. It doesn't look like that right now. I'm only asking you, what are the bargains, what look like bargains to you? Is it consumption? After all, discretionary consumption, food did well in the latest earnings round. So what are you picking? And more generally, is it buy time? Is the earnings cycle itself turning?
See, earnings cycle on an aggregate level makes sense only for large caps, and at that I think will definitely turn because our nominal GDP I think has bottomed out. Obviously, corporate earnings have a big correlation to nominal GDP. Inflation is obviously going to go up. Rupee depreciation helps earnings, right, on the net basis. So rupee is depreciated. That will obviously help pharma, IT, refining, metals, whatever. So to that extent, I think FY27 earnings will definitely, to my mind, be better versus FY26. Uh, but I think the the jack in the box, I think, is Indian manufacturing more than consumption. I would probably think that the potential upside, because if you, as you correctly mentioned, the global economy is actually doing very fine. So when you see the global bellwethers of industrials, which is ArcelorMittal, Caterpillar, BHP, if you see their earnings momentum is fabulous, right? So we are living in a fairly uh, decent capex cycle globally. And let's face it, our biggest export is under threat, which means that I think rupee will underperform yuan by a big margin over the next 3-5 years.
Yes.
And that may actually give the fillip to Indian manufacturing. So I think the space I would probably think has the biggest risk reward at this point of time is Indian manufacturing.
No, actually, that is a very under-discussed issue. We keep saying that we are 6% depreciated versus the dollar. If you compare us to yuan year on year, I think it's like, over a 10% depreciation. For the longest time, I remember we were, 10 rupees, 11 rupees to yuan. Today, it is 13 and a half to buy a yuan.
Exactly. And see, obviously, China is the biggest trade surplus in the world. Obviously, this is a world where the geopolitics is about reducing trade imbalances. I think there's going to be enormous pressure on China to rebalance its economy, which means that the yuan will probably appreciate a lot if China has to get its trade deficit down,
Okay.
trade surplus down, sorry. And on the other hand, if at all AI really impacts IT services, which again is a high probability scenario,
Okay.
then India will have to pivot from a policy perspective, from a currency perspective to manufacturing.
No, actually, something subterranean is happening. I don't know if you looked at the January trade numbers very closely. We were all unhappy that goods exports is flat, but machinery exports were up over 20% and electronics exports were flat. So, there is a lot of differentiation happening. Maybe your manufacturing thesis is right. So are you into, when you say manufacturing, what are your favorite sectors? Is it auto ancillary, cap goods, L&T? What are you looking at?
Yeah, I mean, first of all, I'm more bullish on exporters than domestic, right?
Okay.
I mean, because obviously a TAM will be, the addressable market will be very limited if you are a domestic manufacturer. Now, in terms of exports, I think it starts right from slightly upstream thing like steel to metal forming, to auto ancillaries, to chemicals. It's obviously a vast space. You just need to, but I think capital goods exports is something that looks interesting.
Okay. No, that's very important. Two important themes you're giving us. Look for manufacturing and look for exports. They're likely to do better than those servicing domestic sectors. What's the sense about banking itself? I mean, this is not a fear anyone is talking about just yet. But if we are going to see layoffs in IT space and certainly not increasing employment, is this whole retail consumer loans on which the entire banking system sits under threat? If the stock market is a forward-looking creature, then is this a worry at all, or am I just crying wolf?
I think too early to worry, although we should keep our minds open. Obviously, no one really knows how big the impact will be. But if you see real-time data on GCCs, because RBI has monthly trade services data, right? That is quite strong right now. Last few years, we've seen GCCs have done well, irrespective whether IT services is doing well or not. So I'm a bit more optimistic that this theory that IT services slowing down will kill Indian economic growth. I'm not necessarily of the view because, as I said, we live in a world where global growth is good. We live in a world where yuan versus rupee is given a competitive edge to manufacturing. We live in a world where demographics is actually bad. So maybe the productivity of AI combined with the bad demographics will lead to a Goldilocks scenario where global growth is decent, but interest rates can still come down, right? Because if you see US, 1 year back, everyone thought tariffs will lead to a lot of inflation, right? But it's not come through because there seems to be some productivity growth that is flowing through, mainly because of AI. So I don't think we should be very pessimistic looking at the negative effects of AI. We should remember that AI may actually get interest rates down a lot, which will help markets as
Yeah,
well.
no, I agree with you. I mean, what kind of gains can you reasonably expect, say, from the Nifty in 2026 itself? As you say, the nominal GDP has bottomed out as well. At least the foreign selling appears to have stopped. It is, into a trickle, except for the odd day when there was a 7,000 crore. The selling has stopped.
So, Lada, we've maintained, and I know this may sound like a bit of a diplomatic answer. We think markets, when they're at fair value, we will get 6 to 7% real return, which is above inflation. So, if you believe next year inflation is going to be 4-5%, maybe 6 to 7% real return is quite probable to expect.
Okay. That's still better than fixed income, especially when you look at a post-tax scenario. Thank you very much, Manish Gunwani, for joining us and pointing to some much less discussed themes like exports and manufacturing and perhaps a benign global growth scenario. Thank you for pumping up our optimism on that point. We wrap up on Bazaar on that note. Chartbusters coming up.